Hello traders, and welcome to a video covering trading psychology in market crashes. So over the recent, 2-week period, we've seen some severe volatility on the indexes around the world and indeed in all trading instruments, oil, gold, etc. And we've even seen the Dow move as much as 2,450 points literally in a night. So massive moves, giant movements. And I think it's a really important time to discuss trading psychology in market crashes. So in this video, we'll cover what is trading psychology, the emotions we feel as traders and as humans, market psychology in terms of a graphical form and usually the types of things that happen during a crash, and of course, some key things to look at for us in the market with some back history and what may happen again and again, every time these crashes do occur, similar concepts happen. So we'll be taking a look at those right after this intro. Okay, so let's begin by talking about what is trading psychology. So trading psychology refers to a trader's mindset during their time trading in the markets. And it can determine to the extent in which you are going to succeed in taking a profit, or it can also provide an explanation to why a trader may incur heavy losses. And it's very important to discuss this during this time. So there's really, 5 main things that are traits or things that happen to traders when they trade in the market. We've got happiness, impatience, anger, fear, which is what we're seeing a lot of at the moment, and pride. And it's important to understand those types of psychological traits because especially with pride, I find that a lot of traders, when they first start trading, they think it's easy. And times like what we're seeing here with massive moves on the indexes really does make you generally swallow your pride a little bit. So here we've got the US 30, and we can see that the market is already falling straight back down. We've got that big move all the way from top to bottom here, which is getting onwards of a bear market down at this point, almost 20% down. And I think we're starting to see really an interesting area where pretty much we're feeling a lot of fear, and I'm sure people are definitely feeling a lot of anger towards certain positions. So they might be in a position long and they're starting to get fearful and potentially angry at what is happening to their positions. Now, if you're a shorting and you're selling in this market, of course, you may not be feeling that. So let's bring up a couple of different charts, and specifically we'll bring up a cycle of market emotions first. And it's an interesting chart because effectively this is what happens time and time again. If you were Warren Buffett, effectively this is the kind of thing that he sees all the time. And of course, he likes to invest when people are fearful and panicking and in despair. He buys extra stock and then he holds it because he knows that there's these cycles. So first off, we have the optimism, then we've got impatience, we've obviously got excitement and overconfidence. So we've definitely seen an overconfidence in the market recently from a perspective of the coronavirus. And then of course, we've got denial, regret, fear, which is pretty much where we're at the moment, that regret, fear kind of area. And then we'll have all out panic at some point, and then with despair. So these emotions here in the bear market can happen incredibly quickly. So we've pretty much had denial already. We've obviously got regret. Why didn't I buy at cheaper prices? I'm a bit upset about this. We're in full-blown fear and panic at this stage. And then of course, we'll probably have the despair route, usually when the market goes back down to a very similar area that it did before. So I've actually got the Dow up, and we'll go over to the Dow and we'll see here that last night it rallied, okay? And we've got a series of rallies. We had the rally up here where we had interest rate cuts from the government, sorry, from the Reserve Bank. And then of course, we've got some stimulus last night in terms of America. All of these things are helping to rally the markets, but the markets generally act very fearful, even with this good news. If we go over to something like the ASX 200, we can see here, even things like double tops have been forming on the way down, where yesterday there was a massive wild switch, massive sell-off followed by massive big pullback all the way above the 6,000 point. And then we've got this double top, and that's now broken through. And you can see the aggressiveness of which the market is selling off at even at this live point in time. So very interesting ideas and definitely something that you want to pay attention to in the market. VIX, of course, incredibly high, spiking back up. And generally what the market will like to do is the market usually goes to that point where people don't think it's possible, or people don't think it's a thing that could happen. Here's a great emoji, I guess, kind of way of looking at things. And of course, we've got that fear, then we've got that desperation, the panic, capitulation, and then of course the despondency. So it does become a thing where you can get very despondent to a loss. If you see a market falling down and you've taken, let's say, a significant loss in your trading account, you may get despondent towards money, and that's after your initial kind of steps of fear and pride and all these kind of things happening to you. You might become despondent, and that's actually quite a dangerous area to be. So we need to be aware of these types of emotions in the market, and then we need to think about, well, what has the market done before and what may it do again? So what are some key things for us to look at when we look back at history? And this is where sometimes looking back at the history of markets can help us determine, well, these are the things that are possible, especially as a new trader. So we've got that massive fall off. Obviously, the stimulus packages and interest rate cuts are buoying the market. So here we've got the 2018 crash. So this is the one that went into Christmas, and we had that flash crash coming off the idea of the trade wars. So we've got that initial sell, pick up, sell, pick up, and then of course the support is broken. The support gets broken and the market overshoots, followed by a bit of a pickup and then kind of a retest of maybe around a 50 or 38.2 fib of that pullback. So this is an incredibly quick pullback, but they're not always like that. So that's a very quick pullback. Here again, big sell-off, tests of lows. So we get that initial sell-off, very important. It hits a massive point where everyone's freaking out. It comes up and it almost reaches back to the top, and then it comes down, it tests it again. So an important point of this video would be to realize that the market generally likes to come and test the lows again before moving up. It's very, very common to see this kind of event occur. If we go back even further and we look at previous crashes, here's another little crash. What happens? The market comes down, tests a point, and then it tests it again. Crash, tests a point, forms a base, breaks past the base. So a lot of smart, big kind of longer term investors, they'll actually wait for these bases to be broken. When these bases are broken, they will enter their positions long because they know that the market has considered the current news events, it's thought about them, and it's found a strong area of support, and then that support has broken the resistance and it will move up hopefully to new highs. And of course, with an index or with these kind of assets, you generally expect them to increase over time. So this is what you're really looking for more so in the market. If we think about it from a fear perspective, here's a classic case of a massive sell-off followed by another pullback similar to what we're seeing today, followed by the consolidation, and then of course the breakthrough. If we go and look at previous sell-offs, generally speaking, when you get these big deep ones that go 20%, and we'd have to go all the way back to probably over here in 2011 during that credit kind of problems in Europe, the market will come down and it will hover and give many opportunities into the zone. So I guess the reason we're creating this video today is to discuss the fact that yes, markets will move absolutely very, very sharply. And yes, of course, when you see this sharp move, you should potentially change your trading strategy. Maybe your trading strategy used to be hold positions for a long period of time. And if you're an investor, that's fine. But if you're somebody that wants to be in and out within a few weeks, it could be worthwhile considering more of a day trade or scalping strategy because the markets are so aggressive and they will move up and down potentially multiple percentage points in one night. So top tip would be look for bases in the market. Look for the market to find a low. You could be shorting into that and that's fine. But in terms of buying longer term positions, you want to look for base points, and base points will always usually be some form of consolidation followed by the market breaking to a new high, maybe even a moving average cross of the 20 and the 50 like we're seeing here on the daily, and then it'll move up. So really trading psychology is the market will always go further than you think it could based on that piece of news when it is in a full crash. And that's because it has to weed out all the stop losses, it takes out the leverage, it takes out common sense, and the algorithms start to trade. And I think no greater point in time have we seen that than this Monday, when we saw oil open up at 30% down, massive spikes in terms of VIX, upwards of close to GFC levels, and then of course a huge sell-off in the indices, and expect further volatility as we go through those market cycles over the next coming weeks. So stay safe out there, traders. And of course, when you're looking at markets, always consider your trading psychology. Definitely do some reading on this. We will cover in more depth some top tips in this channel to how to deal with this kind of market in terms of your psychology and how to improve it. Some top tips. I'll probably do about 6 or 7 tips to help you. And it's very, very important that we have our stop losses in and looking at all of the news and paying attention to the markets during this time. Please remember to like, comment, and subscribe, and we'll see you in the next video.